Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Erik Wetterling, founder and editor of the Hedgeless Horseman. We're going to be talking more the psychology around this recent rally, truly in the precious metals stocks, being led higher a lot by just generally higher precious metals prices. Now, Erik, look, this rally really started at the beginning of March when a lot of these stocks bottomed and has actually picked up steam just in the last few trading days, especially for the juniors and for silver. Now, a lot of people are saying, oh, this is still early stages of this rally because it has only gone on for about a month. But there are also people, I'm sure, that are out there looking to maybe take some profits if they did manage to bottom fish just in the last couple months, because stocks really have just retraced to where they started this year. So, Erik, how are you viewing kind of the momentum in this and also the psychology behind finally investors in these stocks having some gains after 4 years of pretty tough trading?
Yeah, so I mean, first of all, I think there are a lot of people who are in this sector right now that have never seen even a bull leg, let alone a bull market in miners. So this feels a bit surreal, basically, to see that juniors can actually go up. And it's like what Rick Rule said, that people have forgotten that juniors can actually go up. So I think there's a lot of things to consider from a psychological perspective. I mean, I bet, there's going to be a lot of people posting shorts about, juniors rocketing, etc. And everybody's always going to draw the impression or get the impressions like, oh, that person was buying at the exact bottom. He's already up 100%, and no point in getting in now because I already missed the train. It's like, I mean, zoom out on some of these junior stocks, what they tend to do in bull legs. I mean, if this is a real bull leg, we're not even close. I mean, the just how this sector works, and it's like you can look at crypto. It's like it's momentum that takes care of a lot of stuff. Yeah, once the momentum gets going, that just leads to more buying and more momentum, which draws in even more people. And I mean, most importantly for me, just look at some of the, let's say developers, look at their NPVs. Think about what some of these projects are worth on paper at $2,300 gold. I mean, we're not even close to anything, any junior really being overvalued. That, of course, does not mean that it says anything about the short-term movement, because they became extremely undervalued. They were undervalued, let's say a year ago, whatever. Then they became extreme undervalued. So it's like fundamentals necessarily don't play a big part in the short to medium term. But I've seen how these rallies can, I mean, how they can go. And back in 2015-16, that epic rally, I was able to hold on because I didn't know better, if that makes sense. I was in mostly trading sardines, and they went up several hundreds of percent, 500-600% from bottom to top. And I just held on because I was greedy. I was, drinking my own Kool-Aid at the top, and at the top it felt like it was going to continue forever. Nowadays, I'm not too comfortable holding trading sardines because if I don't see that something has real value, I mean, on paper anything has value, especially at these metal prices. But I want to feel and have the conviction that there's actually value, that I'm actually paying pennies on the dollar. That makes it a lot easier to just hold through all the volatility and stick to the long term. And especially why I like, some probable and high potential growth as well, because then you have something to look forward to. Even if metals takes a breather, if you think, well, I'm paying 70% discount, and I think this is going to grow and become even more valuable in the next couple of years, then it's like, I mean, you've already won, kind of. Then you're just waiting for the market to agree with you. But some of these trading sardines that's never going to get built, not even good projects to start off with. It's like there's no major or larger company that's going to acquire it. So there's no real natural exit in that sense. And maybe they can't even create a lot of value. So then it's basically just a greater fools trading vehicle. And I'm simply not comfortable holding them, because as soon as metals retrace, I get scared shitless that, oh shit, now it's going to go back to its intrinsic value, which is probably closer to zero.
Erik, I think it's such an interesting point of view to look at the psychology of trading, because to your point, a lot of these people will say, a lot of these investors, that they've got a 2 or 3 year time horizon. They're looking forward to the bull market being 2 or 3 years. But then in 2 or 3 days, they'll be panicking on social media or panicking on chat boards about the moves in stocks, if they've missed it, or if it's not going to, if their junior hasn't moved, what's wrong with this? Maybe I need to get out of it. They have such a short attention span, even though they suggest that their time horizon is years, not days. So how do you deal with the psychology side of it yourself when you see a stock running? Let's just say some of the growth picks that you have, some of the alpha picks, or some of the stocks where you see value creation in them, they do run up double digits or maybe even triple digits. How do you resist the urge to pull the trigger and sell the stock if it's had a nice run? How do you stay the course? Or should you take some profits along the way and pull the trigger? How do you manage your own portfolio in that sense?
I mean, we're kind of wired as humans. I mean, I saw a good tweet on this earlier today. There's like we equal activity to progress, basically, and that's not true necessarily in the investing space. I mean, that's actually one of few human endeavors where you actually probably get better results from doing less, which is very counterintuitive to how we're obviously wired. So, I mean, I kind of have that same problem because I watch, the markets and stocks all the time. But how I kind of subdue it a bit is to make many, let's say, small transactions. Because anytime price changes, the risk reward changes, which makes it easy if you're an overthinker and look for perfection. It's like every single case changes. I mean, a stock goes up 5% on no news. That's a reason, in a sense, to sell a bit, because that just got a bit worse risk reward, and you get paid now, which means less pay later. Yada yada yada. But I would say that, I mean, the hardest thing is that we're all looking to be perfect. That's why nobody buys the bottom, because they're waiting for the bottom, which when it actually comes, nobody knows. I mean, just a few weeks ago, people were telling me that, well, these miners can't go down forever because that's what their recent past told them. I'm not after perfection. And again, if you see, people on Twitter posting stuff, you're always going to feel like you're way behind. And especially if you rode this bear down, let's say you started off minus 50% going into this bottom, and they're rocketing, and you already hear, people, expecting the silver rally to taper off or whatever. It's like you're gonna become paranoid, and you're probably just, many people probably just want to get out even Steven, just be done with it. I think that's why. I mean, I think it's crazy to be selling right now, for example. But obviously, any buy is, there's a seller on the opposite side of that. So I really think it's like you have to really think big and shut out all the noise. Because again, if you compare on Twitter, you're always going to be behind. You're always going to be underperforming every single portfolio, basically, because we only highlight the ones that do well, or highlight the ones we just bought into and want to see, go higher. I mean, that's typically how most of us work. So I just again try to think long term, and in the meantime, of course, since I'm a value shuffler, I mean, if I like two stocks equally, one has responded already, broken out, traders got in, it's up 50%, and there's another identical one, perhaps, that's like nobody's found that yet. I mean, I'm not against doing some value shuffling, especially if it gets you to be more, let's say, have more patience in the overall portfolio, because like I do micro transactions all the time. I think that's a way to just blow off some steam, basically, because I always want to, jump on every opportunity, but I can't trade my entire positions all the time. It's like, oh, a stock is up 10%, this other one is not up 10%. I mean, there's not enough liquidity anyway that I can just bomb out the position at 10% without, dropping it by 30% or whatever. So, but I think that's actually maybe a good tip to, like, okay, if you need to do some action, I mean, do small transaction. You're going to feel like you're doing something, and it's going to add up in the long term, even if it's 0.01% of your portfolio. But at least I think will soothe that manic human nature of like needing constant action, always wanting to do something. But over the long term, I'm fully invested still. I'm going to be fully invested because I believe in every basically holding over the long term. But in the meantime, I'll jump around a bit in a bull market, but always try to be holding companies that I think always have room left to run, because that means that there's better times ahead on paper.
So, Erik, when it comes to this portfolio management, then look, you've even said it. You're 100% invested all the time. And even in bear markets, right, you do shuffle some of your positions. But right now, that it seems like we're in the early stages of a bull market, in terms of your portfolio and the number of positions you have, are you growing your portfolio, taking more companies into it, or are you concentrating your positions in less companies?
Well, that varies a lot. I mean, if I find something that's like, for one thing, and I think I've said this before, it's like at lows, that would be, that's the peak merit of diversification, to make sure you get the next sentiment wave. I mean, if you're highly diversified at the top, you're sure are gonna have big losses. If you're diversified at the bottom, you're gonna catch the next ride. So I think we've talked about this before. A lot of people got trained over the last 3-4 years that alpha is the only thing that works, and you should have concentrated positions. So when that has peak merit in the minds of people, that's actually when you should do the opposite, like diversification and go into beta, which I've done a bit, even though I'm mostly in alpha still. But what makes it even more hard is that it's not only gold juniors that are cheap. We know that silver juniors, they're not as cheap as gold juniors, but we know that they can run a lot. Copper is doing pretty okay. Copper juniors, I would say, are pretty cheap. Zinc is starting to move today. The nickel space is blown out. So I'm a bit in everything, because if there's anything you will get from every single trade is regret. Either you bought too little or too much. And I try to kind of, for my mental health sake, it's like I want to be dabbling in a bit of everything. So no matter how things go, I never feel like I'm 100% wrong. But at the same time, I'm never going to be 100% right. If I would be 100% right in the recent past, I would have been purely in silver beta. But I'm not purely in silver beta. But again, then you see people post about silver beta, and you think, oh Jesus, I missed out on that or whatever. It's like, perfection, forget about it. It's like, if we can have a good to decent return, we're going to be beating most people anyway. It's like that's my main point about, it's like people are not as good traders as we look on Twitter, first of all, and you have no idea how big their losses were before it started running. You have no idea how much they actually manage, or are they in with like 5% of their portfolio in these silver juniors, yada yada yada. So it's like, stick to, in my opinion, to aim for solid returns. Don't aim for like, I gotta be in the exact correct spot exactly all the time.
Yeah, some great points there, Erik, because a lot of people only present, the very best trades they've had. You're not seeing the full story. When you look at your own portfolio, like all of our portfolios, there's winners and there's losers. There's some that have outperformed, there's some that haven't. But you also brought up some other metals there, like you mentioned copper, and I know you look at nickel stocks, and you're even in a couple polymetallic stocks. Do you feel like in a move like this, where we're seeing a breakout in gold and silver is finally starting to get peppier, that you will be more weighted to a certain metal, like more weighted to precious metals right now, and then get back to the base metals later? Or do you like to diversify across the metals that aren't running while no one's really paying attention to them?
That's a good question. I mean, personally, I've been more of a gold, silver doomsday bug. That is like, okay, I think I'm almost bullish on all commodities. I simply think that there might be, before we get to the green cornucopia or euphoria period, there might be some hiccups along the way, and I think gold and silver might actually come in handy before the long-term play for the base metals come along. But at the same time, the base metal plays are kind of priced like there's not going to be a good times in the copper space anytime soon. So it's just very weird, basically, that all the juniors are pricing in worst case scenarios everywhere. But I have a sweet spot for gold, and again, as a value investor, it's like, yes, I know that silver beta tends to do best. And if gold runs, silver can outrun it, yada yada. But that's still speculation. And if we just look at the prices of the metals today versus what it costs to buy them in the ground, I still would say that gold juniors are maybe by far the best risk reward. Everything else is like speculation on a future higher price. So I'm mostly concentrated in gold juniors still. And if they start to run, maybe copper will also run and the copper juniors won't be cheap anymore. So it's like I don't try to predict too much. I try to react to what the opportunities the market gives me. And of course, I'm gonna be influenced what I think is happening on a macro level. But now it's kind of easy because I'm probably more biased towards gold, and I think gold juniors happen to have the best risk reward. So I have a luxury problem right now where it's like I can diversify across metals and I don't even need to pay up, but I can also buy, the main metal gold in the ground, and that's probably actually the best risk reward at these prices.
Yeah, well, hey, gold has broken out to all-time highs and continued higher. A lot of the other metals aren't there yet, but you can also look at copper majors. Those have broken out. Those have actually been following and maybe in a way even leading copper. We all know what the gold juniors have done, and that is broadly lag as well. But hey, Erik, no doubt that there's a lot of opportunities out there. And again, this rally, it's only been just over a month right now. So still early stages. All you need to do is look at a 4-year chart and see how much more upside there could be as long as this keeps on running. Always interesting chatting with you, Erik. Thank you very much for your time. We will chat again next week.
Thank you, guys. And if I mention any companies, consider me biased.